Welcome to Smart Wealth with Joshua.
Your daily stock analysis and catalysts talk. Today we are looking at Circle.
If you find our talks useful, please consider subscribe, like, and comment underneath.
And just quickly before we dive into the numbers, I want to remind everyone that the VIP Algos link is right below in the description.
Yeah, definitely check that out. So let's get into this because I want you to imagine a company capturing a massive 20% chunk of an entire global market.
That's a huge slice.
Right. And its revenue is rocketing up by over 50% in a single year.
Wow.
Yeah. And it's sitting on this commanding $15.5 billion market cap.
Yeah.
I mean, by all traditional metrics of hypergrowth, it is an absolute juggernaut.
Definitely sounds like one.
But, and here's the crazy part, if you pull up its stock chart today, you would see a line that has plummeted almost 70% from its recent peak.
Oh, wow. Yeah, that's a cliff.
Exactly. So welcome to the paradox of Circle, the company behind the USDC stablecoin. We are going to untangle this, honestly, highly complex financial web today.
Right.
We want to figure out if this drastic stock drop is, a flashing red warning sign to just stay away, or if it's a rare, heavily discounted opportunity to get into the very architecture of digital finance.
It really is kind of the ultimate financial mystery of the moment, because in the world of high beta fintech disruptors, nothing is ever as simple as just glancing at a single stock chart.
Definitely not.
I mean, a massive 70% drop looks completely catastrophic on the surface, but when you peel back the layers of what this company is actually building beneath the hood, the narrative takes a really sharp turn.
Yeah.
We are looking at an entity that is fundamentally attempting to reshape how money moves around the globe.
Okay, let's unpack this. Because to figure out why the stock is in a free fall, we first have to look at the engine of the company itself, which, strangely enough, is running hotter and faster than ever before.
It really is.
Let's look at the top line. Circle is experiencing staggering hypergrowth. Their revenue is surging by 51.46% year over year.
Which is massive at that scale.
It's unbelievable. But before we even get into the margins, we should probably clarify how they are actually generating that massive revenue jump, because I think the mechanics of a stablecoin can be pretty confusing for people.
Oh, absolutely. But the mechanism is actually elegantly simple once you break it down. So a stablecoin like USDC is designed to stay pegged one-to-one with the US dollar.
Right.
When a large institution wants to use USDC, they give Circle real US dollars. Circle then mints the equivalent amount of digital tokens and gives them to the institution.
Okay, straightforward enough.
But Circle doesn't just, stuff those real dollars under a mattress. They invest them in highly secure, yield-bearing assets, mostly short-term U.S. treasuries.
So they are essentially acting like a highly specialized bank then.
Exactly.
They take in deposits, they issue these digital IOUs, and then they collect the interest on the massive pile of cash they are sitting on.
Precisely. And with interest rates where they have been recently, that pile is generating serious cash flow.
Okay, so that's the engine driving that 51% growth.
Yeah, and at that immense scale, it tells you that the core product has achieved undeniable product-market fit. People and, more importantly, massive institutions are actively utilizing USDC to move capital globally.
But, and here's where we hit a wall. The unit economics look great on the surface, right? They boast a gross margin of nearly 40%.
Right.
So think of Circle like a tech startup that is building a multi-billion-dollar superhighway. That 40% gross margin shows us that the toll booths they've set up are highly profitable. Every time capital passes through their system, they make good money.
That's a great way to look at it.
But then I looked at their bottom line, and it's just bleeding.
Yeah.
They have a net margin of negative 2.76% and an EPS earnings per share of negative $2.91.
Which naturally sets off massive alarm bells for traditional value investors.
Huge alarm bells, especially when you factor in that they are trading at a premium price-to-sales ratio of 5.41.
Right, so it's not cheap.
No. That means investors are paying over $5 for every $1 of sales the company makes. So going back to the analogy, they have profitable tolls, but that net loss shows they are still pouring concrete at a massive scale.
Exactly.
In a tough economic market, isn't sacrificing profitability just to grab market share a really dangerous game?
Yeah.
I mean, why pay a premium for a business that is losing almost $3 a share?
What's fascinating here is the underlying architecture of that net loss.
Okay, how so?
Well, when a legacy manufacturing company, for example, is bleeding cash, you worry about operational distress.
Yeah, you where they can't make payroll.
Exactly. Or their product is obsolete, and they are headed for bankruptcy. But Circle's business model is entirely different. They hold incredibly high-quality liquid reserves that structurally back USDC. Their fundamental cash position is robust by design.
So they aren't going broke.
No, not at all.
The negative EPS isn't because they are failing to sell their product.
Far from it. That negative net margin is actually a sign of aggressive, highly intentional reinvestment. They are funneling that capital directly into global expansion. They're building out heavy technological infrastructure and, perhaps most importantly, regulatory compliance.
Oh.
They are laying down that superhighway concrete you mentioned, hiring armies of lawyers, compliance officers, and software engineers to make sure the road can actually handle the weight of global institutional finance, all without cracking under regulatory scrutiny.
Which brings up a crucial point about the landscape they are operating in. Because if you're going to pour that much concrete and spend that much capital on infrastructure, you have to ask yourself, are you actually building a wall high enough to keep out the competitors?
Right, because the stablecoin market is completely ruthless.
It really is. You have decentralized grassroots crypto projects on one side, and then legacy behemoths like PayPal entering the fray on the other. And PayPal already has millions of users actively linked to their bank accounts.
The competitive threat is very, very real. And yet, Circle currently holds a commanding 20+% market share.
So how are they defending that? What is their actual moat against a giant like PayPal?
I would argue their primary moat isn't just their underlying blockchain technology. It's institutional trust and incredibly strict, almost painful regulatory compliance.
You're saying playing by the rules is their actual competitive advantage.
I'd take it a step further. It's their absolute survival mechanism.
Okay.
Enterprise users like hedge funds, multinational banks, massive corporations, they despise regulatory headaches.
Sure.
They do not want the SEC knocking on their door because they use some shady offshore digital currency. They demand transparent reserve management.
Right, which makes sense.
Because Circle operates almost like a conservative traditional bank on the back end, holding actual cash and treasuries and publishing audits, they attract the heavy hitters. If a major enterprise integrates USDC into their daily treasury operations, the cost and risk of ripping that out and switching to a less regulated, newer stablecoin is astronomically high.
Ah, so that compliance creates incredible stickiness.
Exactly.
Here's where it gets really interesting, though, because it's not just Wall Street banks taking notice of that compliance. Samsung recently announced native stablecoin support right in its Samsung Wallet.
Yes, that was huge news.
We are talking about bridging the gap between obscure, complex crypto technology and the everyday consumer phone sitting in your pocket right now. But let's break down the mechanism here. How does integrating with a phone manufacturer actually defend Circle's market share?
Well, think about the friction of using digital currency historically.
It's awful.
It was. If you wanted to use a stablecoin 3 years ago, you had to set up an account on a crypto exchange, navigate a confusing interface, write down a 12-word seed phrase on a piece of physical paper.
Don't lose the paper.
Exactly.
Yeah.
And then pay exorbitant network gas fees just to move $50. It was clunky and, frankly, terrifying for the average user.
Yeah, it felt like you needed a computer science degree just to buy a cup of coffee.
Exactly the problem. So when a hardware giant like Samsung natively integrates Circle's infrastructure into the digital wallet that already comes pre-installed on the phone, that friction just vanishes.
It's just there.
Right. It operates invisibly on the hardware layer. It signals to the broader market that stablecoins are moving from a niche internet experiment to a ubiquitous everyday utility. Millions of consumers suddenly have seamless access to Circle's network without even realizing they're interacting with a blockchain.
And for the institutional side, it essentially validates their total addressable market. I mean, if Samsung trusts them, major financial institutions probably feel safer trusting them.
Which is bearing out in the traditional finance world as well. Raymond James actually recently initiated coverage on Circle with a market perform rating.
Okay, and a market perform rating basically means they expect the stock to perform in line with the broader market. It's not a screaming buy from the analysts yet, but it is a massive stamp of legitimacy.
It really is.
It establishes a baseline of institutional coverage. The suits on Wall Street are taking the company seriously enough to dedicate full research teams to it.
And then there is the speculative chatter swirling around the tech sector right now. There are significant rumors circulating about a potential strategic distribution partnership with Stripe.
Oh man, Stripe is an absolute titan in payment processing.
Huge.
If they partner with Circle to process stablecoin payments for their millions of online merchants, that would be a direct counteroffensive against PayPal.
It would fundamentally reshape the entire digital payments map. It would validate their compliance-first strategy on a global retail scale.
Okay, so let's pause and look at what we have on the table so far. We have a company with explosive 51% revenue growth.
Yep.
We have a deep, sticky, competitive moat built on regulatory trust and transparent reserves.
Yep.
We have major tech validations like Samsung and potentially Stripe. By all accounts, the underlying business is thriving. So why in the world is the stock acting like the sky is falling?
This is the Church paradox. It is the collision point between the reality of the business and the psychology of the broader market.
Let's get into the actual numbers on this downtrend. The stock is currently sitting in a deep corrective phase at roughly $62.36.
Right.
That is down 69.28% from its recent high of $202.50. It's barely 25% above its 52-week absolute low of $49.90.
It's been brutal.
The 13-week return alone is a punishing negative 35.24%.
It's a severe, sustained punishment from the market.
But digging into the most recent data, there's a tiny glimmer of a shift. The 5-day return has ticked up 2.84%. And more importantly, the trading volume has normalized. It's currently sitting at about 15 million shares over a 10-day average. What does that volume normalization actually tell us about investor psychology?
Well, when a stock is in a free fall, you typically look for an acceleration in selling volume that signifies pure panic. The fact that the volume is leveling out at 15 million suggests the panic selling has largely exhausted itself. The weak hands have essentially exited. It hints at early signs of bottom fishing, meaning institutional investors are looking at this $60 level, seeing the 51% revenue growth, and quietly stepping in to, buy the dip.
I hear the argument for bottom fishing, but I'm going to play the skeptic for a second, because there is another metric in the data that is glaring, and it has to do with the people actually running the company.
Ah, the insider trading.
Yes. Over the last 90 days, insiders have net sold over 2 million shares. We are talking about 180 distinct sell transactions by executives compared to only 37 buys.
Right.
If the insiders, the people who know the most about the company's future, are dumping millions of shares into a 70% drawdown, why shouldn't the average investor just run for the hills?
If we connect this to the bigger picture, insider selling in the tech sector is rarely the massive red flag retail investors assume it is. You really have to consider the life cycle and the compensation structure of a high-growth tech company.
You mean how executives are paid in stock instead of massive cash salaries?
Precisely. Executives, early employees, and founders often have the vast majority of their net worth tied up in restricted stock units, or RSUs.
Right.
When lockup periods expire, or when pre-scheduled trading plans like a 10b5-1 plan trigger, they sell. And they sell for entirely mundane reasons, paying massive tax bills, diversifying their personal portfolios so they aren't completely exposed to one single asset or, buying real estate.
Sure.
A predetermined stock sale plan means an executive didn't just wake up, look at the chart, panic, and hit sell.
So it's not necessarily the captain abandoning a sinking ship. It's just them finally cashing a paycheck they've been working years to unlock.
In the vast majority of these cases, yes. What analysts actually focus on is the buying.
The 37 buys.
Exactly. The fact that there are 37 distinct insider buys is incredibly telling. It means members of the management team are looking at this 69% discount, taking their own hard-earned personal cash, and deciding to scoop up more shares. They see fundamental value at $62 that the broader market is currently missing.
That reframes the insider data entirely. And it leads us to another metric that explains these wild, violent price swings. The beta. Circle stock has a very high beta of 2.31. Let's break down what that actually means for your portfolio.
Beta is essentially a measurement of a stock's volatility compared to the broader market, like the S&P 500. So a beta of exactly 1 means the stock generally moves in perfect lockstep with the market. If the market goes up 1%, the stock goes up 1%.
Okay, so a beta of 2.31 means this thing is highly, highly reactive.
It acts as an amplifier. It's a coiled spring. If the broader market gets slightly spooked by economic news, the stock isn't just going to drop, it's going to drop more than twice as hard. But inversely, if macroeconomic conditions improve and the market gets optimistic, this stock is mathematically primed to snap upward aggressively.
So what does this all mean? It
Mhm.
means we have to look outside the company itself to understand what could trigger that spring. Since the stock is so hypersensitive to the broader world, we need to map out exactly what catalysts could launch this thing back up and what storm clouds could push it back down to its absolute low of $49.
Let's start with the bullish catalysts, the potential upward triggers. First and foremost, we have their upcoming earnings report. Wall Street is going to be watching the margins like a hawk.
The ultimate test of that pouring concrete analogy.
Exactly.
They need to prove they can maintain that 51% revenue growth while simultaneously narrowing that negative net margin. Investors want to see that the heavy, expensive infrastructure phase is starting to taper off and operational leverage is finally kicking in.
Beyond earnings, the market is anxiously waiting on the concrete details of that Samsung wallet integration. The announcement was great, but the market wants transaction data.
They want to see it actually being used.
Right. If that rollout shows immediate, massive consumer volume happening natively on smartphones, that is a direct, undeniable ingestion into Circle's top line.
But according to the analysis, the biggest bullish catalyst might actually be sitting in Washington, D.C. right now. The Clarity Act.
Yes, the legislative wildcard. There is significant legislation moving through the U.S. Congress right now aimed at finally providing clear, permanent regulatory frameworks for digital assets and stablecoins.
And just the hope of the Clarity Act passing is already providing massive regulatory tailwinds for the entire sector. I mean, we've seen that optimism help push Bitcoin back up towards $66,000.
It's a huge driver.
If there is actual forward movement on that legislation, it will provide a profound valuation re-rating for compliant issuers. And remember, Circle's entire competitive moat is built on regulatory compliance. They are perfectly positioned to benefit from clear rules of the road.
Absolutely. Add in the potential for broader economic rate cuts by the Federal Reserve, which traditionally drive capital out of safe havens and back into high beta tech stocks, and you have a potent cocktail for a massive rally.
However, we do have to talk about the storm clouds, because right now, the global macroeconomic environment is incredibly tense, and those risks are largely out of Circle's control.
Right. We are looking at massive geopolitical headwinds. The data points to escalating conflict in the Middle East, potential blockades in the Strait of Hormuz, and the very real fear of crude oil surging past $100 a barrel.
Let's connect the dots for the listener here. Why does a conflict halfway across the world and a spike in oil prices crush a digital stablecoin stock?
It comes down to inflation and interest rates. When oil spikes to $100 a barrel, energy costs soar, which makes everything more expensive.
Right.
That keeps inflation sticky. When inflation stays high, central banks are forced to keep interest rates elevated. And when borrowing money is expensive, capital gets tight.
So people pull their money back.
Exactly. Large institutions pull their money out of risky, highly volatile, high beta assets like Circle, and they flee to the absolute safety of government bonds.
So when you weigh the scales, do the massive geopolitical fears of $100 oil completely overshadow the optimism of the Clarity Act and the Samsung integration?
It is a brutal macro tug of war, but this is where the stock's current beaten-down price becomes the crucial factor. A near 70% drawdown suggests that a massive amount of this macroeconomic fear, the oil prices, the geopolitical tension, the tight capital, is already priced into the stock.
Wow.
The market has already violently punished Circle for the broader global uncertainty.
So the bad news, or at least the fear of the bad news, is largely baked into that $62 price tag.
To a significant degree, yes. But this raises an important question for anyone looking at the company's fundamentals. Can Circle's revenue growth outpace its fixed operating costs before these macro shocks dry up institutional capital entirely?
That's the million-dollar question.
Because if the global economy tightens up drastically, that negative net margin suddenly becomes an existential threat. They have a 51% growth rate, which gives them a tremendous runway to outrun those fixed costs. But Make no mistake, it is a high-stakes race against the macroeconomic clock.
It's a race with billions on the line. So let's bring this all together and synthesize the final verdict based on everything we've analyzed today. Despite the massive, agonizing drop from its all-time highs, Circle earns a bullish score of 6 out of 10.
Which is a solid, cautiously optimistic rating for a highly volatile asset.
Right. The core takeaway here is that this is not a quick overnight flip. The analysis views this as a multi-year play, meant for accumulating on weakness.
A long-term vision.
Exactly. Because once these current macro headwinds clear, if oil stabilizes and geopolitical tensions ease Circle's regulatory compliance mode, combined with its staggering 51% revenue growth, position it for a massive valuation re-rating. They are building the financial infrastructure for the next decade, and right now, because of broader market panic, that infrastructure is arguably on sale at a massive discount.
It ultimately comes down to a philosophical question. Do you believe the digital economy will require a compliant, regulated bridge to traditional finance? If you believe that bridge is necessary, the data suggests Circle is currently the strongest, most resilient bridge being built.
Which leaves us with a final thought to chew on. We started by comparing Circle to a company building a massive superhighway, pouring concrete at an unprecedented scale. And now, with hardware giants like Samsung integrating these stablecoins natively into the smartphones that millions of people carry in their pockets every single day, how soon will it be before you're standing in line, paying for your morning coffee with a digital dollar, entirely unaware that you were even using crypto infrastructure?
It's coming sooner than people think.
The ultimate success for a company like Circle might not be flashy or disruptive in a way we can see. The future of money, it seems, might just be completely invisible.
Well said. And a quick reminder, if you want more insights like this, the VIP Algos link is below in the description.
Yes, check that out. And please remember to subscribe, like, and comment underneath. Thanks for tuning in, and we'll catch you on the next one.